Joining us on the phone line is Parag Thakkar, Head Fund Manager at Fort Capital. Welcome to the show, Parag. I wanted to ask you up first, how should an investor, kind of look and what his or her strategy should be in markets currently, given that domestic tensions with neighbors are high and there's a lot of global uncertainty that still creeps in?
Thanks a lot for having me on the show. Am I audible?
Yes, you are.
Yeah. So basically, after this recent rally in the Nifty, and of course, as you rightly pointed out, the tensions around at the border and on the global level of trade tariffs and all, I would say that you have to be bottom up, stock specific, and sector specific. That should be the strategy going ahead because one big rally has already happened.
Got it.
And market is showing huge resilience to all the negative news. So one cannot be very negative also on the markets.
Got it. So right now, are you more inclined to, the large cap space, or do counters in the small and mid cap space look attractive as well?
So basically, I'm market cap agnostic right now after this recent rally, which is caused by FII and domestic institutions buying in last 2 months in large caps. Till 2 months ago, definitely large caps were better choice because they were offering value due to FII selling. But now that in February, mid caps and small caps crashed, and after that, there's no big follow-up buying which has happened in mid caps and small caps. I would like to be sector and, as I said, stock specific. For example, with a disclaimer, I'm saying that I'm overweight on cement in the portfolio, and I continue to like cement stocks significantly because of the pricing discipline which has come, and some of the companies which might reduce debt also in this cycle. So I would be very positive on. So basically, in mid cap and small cap space also, particularly cement is a sector which I like.
Okay, I'll come to the cement space because that's something I want to talk to you as well. But I want to highlight the textile space that is buzzing in trade today as well as yesterday. Pull up something like a KPR Mills or even Arvind Fashions, Welspun Living, Trident. They all saw strong moves in trade yesterday, and KPR Mill up over 7% today. And this is all on the back of the potential opportunity that the India-UK FTA opens up for duty-free textile exports. Now, wide range of Indian products will receive duty-free entry in the UK. The FTA is expected to boost exports in the labor-intensive sectors as well. Parag, how do you, do you think there's a play here in the textile space?
So we have a huge opportunity in textile industry in terms of both in US and Europe. Currently, our home textiles are getting more exported more to US. But of course, there's an opportunity for companies like KPR Mills, as you rightly pointed out, which is a high quality company. Once this UK FTA also is signed, and so because it will attract lesser duty in UK, and so it will open up more opportunities for them. And it is already a very recent company with about 20% ROC history from last many years. So I would say that, but of course, valuations have now become a little bit I would say expensive. So, so that is only the problem. And all these treaties and all will take some time to get implemented. Before that, we'll get another opportunity to buy. So I would say that I'll not chase the momentum at this point of time, but the opportunity is large.
You said valuations are slightly expensive. Are there any current, picks that you have in the textile space where the risk reward stands favorable on the reward side, despite maybe valuations being slightly higher than the historical average?
No, so some of the names which you highlighted are good, no doubt about it. Whether it is KPR Mill kind of garment manufacturers, Gokul Das kind of garment manufacturers, or home textiles, all these are good names. But as I said, we don't chase the momentum, and sometimes market runs on narratives, and we don't chase the narratives. As a principle, we don't chase narratives.
Now, I want to talk about the cement space, and we've seen prices improve. We actually had an MK note come out today, which says, resumed the coverage on the cement space, and they do expect, multiple, tailwinds in favor of the space. Parag, we've seen, muted pricing. You've seen improvements. Do you expect, the kind of marginal improvements that we're seeing every month to continue? Or can we expect like a significant bump up in prices?
So basically, see, as I told you, after there was a big consolidation in the sector, there was the expectation that price hikes will be happening. It has happened in East in January, February, March, as reflected in the results of Eastern companies. Somehow, some price hikes happened in North also. But I think after 1st April, what we have seen is there has been a decent improvement in the prices in South, and this was the region which was laggard from last 5 6 years actually, because of oversupply. And now that the price hikes are happening, the very good genuine business companies like Remco, and with a disclaimer that I own Remco and India Cement, which are South cement companies in our portfolio, and it has been bought from long-term perspective. So I will put a disclaimer there. It is not a trading buy, but I would say that these companies will benefit from increased EBITDA because of higher price realization. And as I keep saying, that good companies always try to do good things during bad times. So when the times were bad, I think the companies like Remco have started reducing debt by selling their non-core assets also. And on one hand, this pricing benefit will give them tailwind to further reduce debt, and they are increasing capacity at the lowest cost per ton, which is $35 per ton. They are adding capacity by 25% to 30 million tons. So I would say that all this combined in a long-term 2 to 3 year view, these companies look like minimum 50 to 60% you can get in this kind of companies.
Got it. Parag, I wanted to ask you, we saw, since late 2023, around 64 million tons per annum of capacity being acquired. Are there any trends that, maybe the pace of consolidation in the sector will now slow down? Because, the kind of likely candidates, there are very few in the space.
Absolutely. So the very weak players got bought out first.
Yeah.
And then, of course, we saw some of the good players like Orient Cement also getting acquired. Ambuja Cement, in its recent call, had put emphasis that we are going to grow organically more now. So I would say that you can say that 1 or 2 acquisitions can still happen, but more or less it is done. And hence the pricing scenario is improving. And plus, of course, the government spending, which was not there last year, with April GST collection of 2.37 lakh crores and RBI's dividend coming in June, July, I think government spending should be enough. The Pradhan Mantri Awas Yojana is gaining momentum in some of the states like East and all. Amravati project will boost demand of cement in South. So I would say that the demand environment looks okay. And it will gradually pick up if we have normal monsoon again. Rural housing will pick up in second half. So I would say that the tailwinds are there, and this is a sector which is where if you increase the prices, your profitability improves significantly. And remember, most of the players in the industry were generating very low ROEs. So it was a need of our for them to keep investing in the business. Also, you need profits, right? So basically, this price hike was due very much. It got delayed, but now it has started to happen.
Got it. The next, sector I want to focus on is the oil and gas space. We've seen the OMCs, report their Q4 numbers. So I want to talk about that first. You've seen the companies beat, the EBITDA estimates, and we've seen them, even in the refining front, beat the benchmark. But your LPG losses still remain at highs. You have around 10,000 to 18,000 crores across IOCL, BPCL, and HPCL. Is the OMC pack something that looks attractive?
So they look attractive, but generally as a policy, we don't invest in these companies because there are so many moving parts here. As you rightly said, government policy, oil prices, there are so many moving parts that you have to buy it grossly cheap. And right now, after the recent rally, I would, again, as I told you, I would not chase momentum again. But of course, if the oil prices continue to be below 65 and if government allows them to make good marketing margins, the stocks are the stocks can still see some upside. But as I said, we don't own OMCs in our portfolio, and we don't intend to buy after this move.
What about the gas counters? I mean, maybe not an MGL in Q4, but something like an IGL. It did see, its EBITDA expand 5% on a quarter-on-quarter basis. Even the unit EBITDA has seen some improvement, and they are expanding geographically. Does the gas space look more attractive?
No, so basically, see, again, here also there are many moving parts, right? Government reduced that APM gas allocation to them. And after that, we have seen IGL taking some price hikes, which will protect their EBITDA. So again, I would say that these are the areas where you have to be very nimble, agile, and you have to then sell also very quickly once the thesis actually turns. So I would say that these are great franchises, I would say IGL and MGL, good ROC businesses, good net cash balance sheets. But after the recent thing which government did, that they reduced that APM gas allocation to them, I would not be a buyer in them.
Got it. And lastly, Parag, I want to ask about something like an ONGC and Oil India. I mean, I keep on, like, you've seen volume growth and production that has been missing for a while. Currently, even the oil prices are not in favor for the oil exploration companies, and gas prices are packed, but there's still a lot of bullishness in terms of brokerage ratings on the counters. Why is that so? Is there still some strength in something like an ONGC or an Oil India, or is it purely just based on cheaper valuations?
So, see, they are good dividend yield plays. Plus, the contra investors like me or some other fund managers would always see value when the oil prices are down, right? When oil prices are down, you have to buy ONGC. You cannot buy it when it recovers to $80, $85 because by that time the stock price would have gone up. So I would say that it's a good contra value buy where the dividend yield is very good, where the production is, as you rightly said, production is set to increase, and that is why some of the brokerages are also bullish on ONGC because after a long time you are going to see increase in the production.
Got it. Thank you so much, Parag, for talking about all the kind of spaces that we mentioned today, and we hope to speak to you very soon.
Thanks.